The Fed is clearly in the news with all the discussion on whether they're going to raise short-term interest rates and whether they're going to really taper in earnest and reduce the size of their balance sheet. These two items are somewhat conflicting. If the Fed raises short-term rates in order to combat inflation, it will also slow down the economy. Generally, when the economy slows, long-term interest rates go down. However, the flip side is this. Tapering is buying less long-term bonds, less mortgages, and if the Fed does that, long-term interest rates should be going up. This dichotomy or conflict is going to have to be resolved. The economy right now is moving along very quickly. However, if the Fed moves too forcefully and reduces business confidence, consumer confidence, and the economy begins to slow, we could have a situation where the slowing economy is too much for the markets to handle, and the markets could react very negatively, and the Fed would probably end its tightening phase. In addition to that, the tapering element of buying fewer bonds is going to be a situation where rates could go up as long as they've not slowed the economy down too much. So we're probably going to be in a situation where they do taper, the economy remains strong, they don't raise short rates too much, and the inflation continues to move at a very high level. That will eventually force the long part of the bond market up. We will then have a steep yield curve, but with that issue, bonds are going to be a very bad place to be over the next several years. We advise investors to reduce their duration, and we think that holding long bonds is a very dangerous situation. You should be reducing your exposure, especially anything over 5 years. This is not investment advice. Please check our full disclaimer on buildingbenjamins.com, and we hope you have a great day. Thank you.